Hello, today we'll figure out where to invest in 2023 and how to distribute your investments. First, let's figure out what type of investments do exist. There are only three categories of investments: high risk, medium risk, and low risk. So, what are high risk investments? High risk investments, often advertised as high return investments, should always be treated with caution. They are only suitable for investors who understand the risks and are prepared to lose all of the money invested. High risk investments may offer a chance of higher returns than other investments might produce, but they put your money at high risk. This means that if things go well, high-risk investments can produce high returns, but if things go badly, you can lose all of the money you invested, and the chance of things going badly is higher. Now, let's take a look at low-risk investments. By nature, with low-risk investing, there is less at stake, either in terms of the amount of invested or significance of the investment of the portfolio. There is also less to gain, either in terms of potential return or the potential benefit bigger term. Low-risk investing not only means protecting against the chance of any loss, but it also means making sure that none of the potential losses will be devastating. If investors accept the notion that investment risk is defined by loss of capital and underperformance relative to expectations, it makes defining low-risk and high-risk investments sustainably easier. And now about medium-risk investments. Medium-risk investments are investments in which the volatility is lower than high risk but lower than low risk. In general, this investment is somewhere between the other two. Now let's talk about how to distribute your investments. In what type, how much should you invest? High risk investments should not make up more than 10% of your investment portfolio because they're quite volatile and it's not worth risking more than 10% of the portfolio. Of course, it all depends on the amount you invest, but it's still better not to take risk. Medium risk investments should not exceed 30%. This will help you to get a chance to make good money if any of the assets rises in price. At the same time, you do not draw as much as high-risk investments, and in the end, low-risk investments should make up the majority of your portfolio, 60%. These are the most stable investments that you do not risk when investing, and that brings constant profit. In the long run, these are the most reliable investments that will most likely help you multiply your savings and will not constantly bother you with their risks. Now that you already know what types of investments exist and how to allocate your investments, we can talk about where exactly you can invest your money. Let's start with high-risk investment. So first is value stocks. Value stocks are stocks that are being traded at relatively low price, as investors sometimes view them as undesirable, which drives their price down. However, if you're patient, value stocks could yield significant profit down the road since you can buy them at very low price. Value stocks are best for high-risk investors who are willing to commit a long-term investment. Of course, there are some risks. Value stocks tend to fluctuate more than bonds and are often riskier than growth stocks. When you invest in value stocks, you're betting on a company that many investors may view as unfavorable. When you invest in value stocks, you're betting on a company that many investors may view as unfavorable. Value stocks are more affordable than most growth stocks and tend to perform better than growth stocks when interest rates rise. Second are cryptocurrencies. Cryptocurrencies has been one of the hottest investments in last few years, largely because of the price volatility. Coin prices tend to fluctuate dramatically since they are influenced by supply and demand as well as media attention. As a result, investing in crypto has become popular because of its high risks and potentially large payoff from relatively small investment. Cryptocurrencies is popular with investors with high risk tolerance. You can score big on crypto, but the price of the coin can plummet quickly. One of the risks is that you can lose everything. Just as easily as coin gains significant value in a short amount of time, it can lose all the value as well. While crypto has been down in 2022, market has grown exponentially in the past decade. If you have held onto your coins for the last 3 to 5 years, you've likely seen significant gains. Now, let's look at the medium risk investment. Corporate bonds. Corporate bonds are typically issued by successful companies and can oftentimes yield high dividend. In 2022, corporate bonds yields are near multi-year highs and tend to be less risky than stocks. When you invest in corporate bonds, you're essentially bidding on a successful company to continue being successful. Corporate bonds are a good option for medium risk investors looking for a less volatile investment option than stocks. Corporate bonds are less volatile than stocks and may yield more than government bonds. Dividend stock fund. Dividend stock funds are mutual funds or exchange traded funds that invest in stocks that pay dividends. These funds allow you to diversify your investments so you're not relying too heavily on one company. When you're buying a dividend fund, you're anticipating the companies with the fund will continue to profit over time. If you choose carefully, you may get payouts on a quarterly basis. Dividend stock funds are appealing because the investors can profit through increases to the share price as well as dividends paid by the company. Unlike stocks, dividend stock funds may pay out cash on quarterly basis, provided the company remains profitable. If the company is generating profits, you will receive cash on a regular basis. Target date funds. Target date funds are retirement funds that allow you to choose a target retirement date, and the fund will allocate your investment based on the date. Target date funds take the legwork out of investing. Once you invest, the fund will do all the work of balancing risks based on where you are in the cycle. Target date funds are best for people who are saving for the retirement. Target date funds diversify your assets for you, meaning you don't have to manually diversify your portfolio after investing in target date fund. Of course, since a target date fund is an investment in the stock market, therefore inflation and down markets can affect your income. And finally, we came to S&P 500 index fund. Investing in the S&P 500 means you're investing in the 500 largest companies by market capitalization. As a result, you may be more likely to profit over the long term. By investing in the S&P 500, you're casting a wide net and automatically diversify your portfolio since you're putting stake in 500 different companies. The S&P 500 is great for beginner investors willing to hold onto a long-term investment. Investing in the S&P 500 doesn't require a ton of market savviness. You know you're investing in large, successful companies. Of course, while the S&P 500 is a less risky investment, it still consists of stocks. Therefore, your investment can be subject to market volatility. And that's it for today. Thank you for watching our video and see you soon.